And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Just to follow up, yesterday the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat. High inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, and the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment.
Well, this has been an unfortunate turn of events.
All right. Today is Sunday, the 23rd of March. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. We're coming to you live from Sin City, Las Vegas, Nevada, USA. Folks, where do we begin here? Hope everybody's having a great weekend, but you better buckle up and be ready at the high state of readiness as we enter one of the most critical weeks in economic history. Why? Because it's going to be the last week before Liberation Day. You're excited? Liberation Day. According to the White House, when the tariffs comes out April 2nd, that's Liberation Day, when we crash the stock market altogether and blow up the economy and be liberated. But of course, there are rumors that Liberation Day might be delayed as President Trump pushes out again on his tariff threats. But we will talk about that in a minute when we talk about the market. But did you catch the FOMC this week with Chairman Powell, Clown Powell, who came out just a few months ago and said, I don't see the stag or the inflation, to be honest with you. Well, you see it now, bitch? And I know what he's going to say. He's going to say, inflation is the tariff problems. And the recession, I don't know, something wrong took place. We're investigating now. We'll let you know the results after you lose your job, the house, the car, and the wife. We'll let you know then. But folks, isn't it amazing that in times of economic uncertainty, With all of this chaos and nobody knows what's going to happen, shouldn't the Federal Reserve be at least a source of confidence? Shouldn't the Fed chairman at least know a thing or two of what's going on with the economy right now? But as you've seen so far, and you will continue to see in this program, Chairman Powell is absolutely clueless. He has no idea what's going on. He's a follower, not a leader. He's just reacting to whatever fake data that comes out, which we might as well just replace his job with AI. Instead of paying the hundreds of thousands of dollars in salaries and then millions of dollars in travel fees and all of that. But then who's going to do the insider trading, right? Oh, sure, let's keep the Fed chairman then. Imagine that. The zombies at the Fed got caught insider trading repeatedly. It's a culture. And nothing happened. Business as usual. And those of them who get really too embarrassed because they've done it repeatedly, got caught red-handed, oh, they graduate and they get a job at PIMCO or Goldman Sachs. You wonder why the Fed is an absolute mess right now? And if you thought that we have economic uncertainty and things are about to head off a cliff because we have a maniac in the White House who wants to impose the highest cumulative tariffs in this country's history and keeps backpedaling, oh, we're going to do this, no, we're going to extend, no, we're going to negotiate, no, we're not negotiating, no, we're going to do absolute chaos. On top of that, you have a clueless Fed chairman. What could go wrong here, folks? And this week, Zombie Powell brought back transitory. Oh boy, take a look.
We're back to transitory again?
So I think that's kind of the base case.
So now he says, oh, inflation is going to be transitory again. How the hell is this guy still holding a job as chairman of the Fed after all of the disasters that he's done? All of the failure that we see right now is a product of his legacy. I'll show you in this program disturbing data because a lot of folks don't understand how recessions and crashes happen, but they begin with the psychology, and the psychology is becoming dire in this economy. But before we begin, since I'm a boxing fan, let's say condolences to Big George, who passed away at the age of 76 this weekend. It's sad when they go so young. But Foreman was an inspiration because if you thought that you're too old to do something, this guy was in his 40s, was overweight and pulled the shorts all the way to his chest. And he was a killing machine, landing these big tanks and giving you brain damage. Speaking of, I'm not just a boxing fan. I wanted to go pro, but then I decided to choose career over brain damage. Even though my wife disagrees, she thinks I have no career, and I got brain damage regardless. But with that, folks, let's dig deep here on the main topic of conversation that we have tonight, and here it is. In focus tonight. Game over. Things are getting freaky out there, folks. And look at Powell here. The headline says stagflation ? Fed sees higher inflation and the economy growing by less than 2% this year. And look at Powell with this stupid look on his face like, oh shit, here we go again. I thought I got this handled. I thought we got a soft landing. What happened here, Mr. Powell? And the truth is, everybody feels it. I mean, you look at the BOFA gave us some data this week, and you can see that expectations for the global economy in the next 12 months, the predominant theme is stagflation. Goldilocks in the toilet. Stagnation beginning to gather some steam. Boom went kaboom. And now we got stagflation dominating the outlook for the economy. And this is not a surprise to anybody who's been watching this channel for the last few years. Since the whole thing began, we told you it's going to end up in a stagflation. Then they're going to have to resort to a recession. And the longer they delay the recession, the deeper it is and the bigger the crash. And the scariest part is that the folks who we trust in the position of power to handle the economy are absolutely clueless. This week in the FOMC conference, Chairman Powell was asked about the inflation risk in the economy, and this was his response. Take a listen.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations. And people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example.
So what the hell is he talking about? He has absolutely no clue what he's talking about. He says longer-term inflation expectations are well anchored. What are you talking about well anchored? Inflation expectations by the U.S. consumer for the 5 to 10 year is at the highest in more than 30 years. How could he come out and say, oh, it's well anchored? It seems like it's getting out of control here, buddy. And of course, we showed you this last week. The clearest indicator for stagflation in the economy is what we got from the Consumer Confidence Index. So consumer sentiment is dropping like a rock, and that is recessionary. At the same time, long-term inflation expectations, the highest since 1993, Mr. Powell. Are they giving you the data or just spending your day getting high and just hearing a few reports before you come out? And the coaches, the Fed hires speech coaches for him before the conference. The guy's an absolute disaster. He just dismissed the inflation risk altogether. That, yeah, it's well anchored and, oh, by the way, it's transitory. What about the recession risk, Mr. Powell? As we see consumer sentiment plummeting like we've seen here in the latest report. Here's his response. Take a look.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car.
So again, he says the consumer is doing fine. Look at what they do, their action. They buy a car all of a sudden after complaining for a few months. Well, they have to because prices are not going down. We've been waiting. At some point, you're going to have to buy a car or buy a house if you need. It ain't pleasant. We're drowning in debt. And when you say that the consumer is doing fine or doing good or whatever, haven't you looked at the latest consumer spending data? Here's the headline for you. Consumer spending posts the first drop in almost 2 years. How could you say that the consumer is doing fine? Because they live in a bubble. He gets his information from his buddies at Wall Street and the hedge fund managers who he sells insider information to. He gets his information from the New York Economic Club and the Yacht Club and the golf courses, not from the regular economy and working folks. You look at the perceived likelihood of a U.S. recession over the next 12 months. This is according to the Conference Board. The reading is moving higher. We've been over 50% for a while now, and the trend doesn't look good. It looks like recession fears are beginning to be amplified in the economy. Likewise, when we talk about corporate default risk, the average 1 year expected probability of default for U.S. public companies. Look at this chart right here. We're moving even past the highs of the pandemic. You look at expectations for the labor market. Check out this chart right here. The reading is plummeting. Consumers, households are expecting more and more layoffs and lesser chances to find a job. We only see these kind of readings preceding a recession. And if that was not enough, company after company after company comes out in this earnings season, warning us that the tariff risk is, of course, going to be inflationary because they have to pass the extra cost down to the end consumer, you and I. But at the same time, they're witnessing consumers being weaker already. Add to that the tariffs. How the hell would they be able to pass the extra cost down to the end consumer? It's going to be a disaster. They're going to have to eat a loss. If they pass it down on the consumer, they're going to lose more and more consumers. We got these warnings from Walmart, from Target, from many other stores, Ross. And the latest, of course, is FedEx. FedEx is a leading indicator for the economy. It was an absolute disaster. FedEx is the latest company to sound the alarm on the U.S. economy. FedEx cuts profit outlook for the third time in a row. We haven't seen FedEx do any of this absent of a recession. It wasn't FedEx alone. Nike, also with an economic red flag about the consumer. We got warnings from the airlines. Delta Airlines, United, all of them warning. They're cutting forecasts. raising an early alarm about consumer spending. All of these are leading indicators to what's going to happen to the economy. Transport, FedEx, UPS, the airliners, the trucking stocks, the housing stocks. Anybody with half a brain, let alone the Fed chairman, anybody with half a brain knows that when you have stocks in housing, retail store stocks, airliners, transport stocks, shipping stocks, when these stocks begin to top and then crash and they go down in the bear market, down 20% from the top and more, as we already see in housing stocks, in airliners, in trucking, in UPS and FedEx and many more retail stores, this stuff usually happens before the crash and the declaration, at least the official declaration of a recession. And you got to be worried when you see these kind of things in the market. So how the hell does the Federal Reserve doesn't know any of that? And we're seeing the damage in airliners, in transports, in travel and leisure, which has been one of the hottest sectors of the economy, a huge source of job creation outside of government, which we know right now with Doge, they're cutting government jobs. Okay, so we got the only engine in the economy is healthcare, because we have an aging population. That might sustain because it's a necessity. But then the other sector, the cyclical sector that has been creating jobs, is leisure and hospitality, airlines, cruises, hotels. Why? Because the affluent consumer has been doing the majority of spending in the economy. And the affluent consumer have been feeling pretty good as they look at their stock market portfolios up and up and up every day, not realizing it's a bubble. And all bubbles act and react the same way. They end in a disaster. You shouldn't be excited about it. You should plan on how to maximize your gains and lock them and then hedge on the way down. But we have this euphoric sentiment across the economy and the investing community and the traders community, where they still believe that nothing is going to hurt us. We're going to shake it off, and every drop we're going to get is just an opportunity to buy the dip. They're going to buy the dip until they realize that all of this was just a giant, the greatest wealth transfer in the history of mankind. But now we're beginning to see warning signs about the economy, because if you look at the delinquency rates, high earners are now facing more delinquencies. And when the stock market goes down, that's double the pressure. Of course, they have to pull back from dining out at restaurants. They have to pull back from their travel plans, which will impact cruises, airlines, hotels, and many others negatively. And again, to this cocky, arrogant behavior and sentiment that we see all the time from investors and traders. And by the way, most of these investors and traders, they joined the market during the pandemic. So they have absolutely no clue how markets work or how the economy works. All what they know is just the recency bias. They think, yeah, every problem we got in the last 4 years, it was fixed. The Fed fixed it at the end of the day. But we keep going higher. You might not want to consider putting all of your eggs in the Fed's basket to rescue your ass, because the Fed perhaps needs a rescue this time around. You look at the Federal Reserve net income, it's negative. They're losing money. They're down over $77 billion. We haven't seen anything like this, by the way, where the central bank of the country is losing billions and billions of dollars. What you're looking at right now is a collapse of the Roman Empire. With all of the national debt that we got, and the inflation that we're going to have now because of tariffs and stupid policies, what do you think is going to happen here? Maybe we're enjoying, this is the last hurrah, this is the last dance, and maybe our lives will be changed drastically in the next few years, if not decades. Maybe we'll look back at this era right here and say, wow, the standard of living was way too high. We took that for granted. Now we're sitting at the street corner with filthy clothes and dining on a tuna can. Brings you back to college days, you know? I mean, who doesn't want to be forever young? Think about it. But folks, if you say, Mav, I don't care what you say, FedEx, Nike, consumer, whatever, all of these indicators mean nothing. We're going to buy the dip. The economy is going to be the roaring 20s, and none of this matters. Okay, I'll give you the most accurate indicator in financial history, and let's see what it says. Ladies and gentlemen, welcome to a segment we call the Hoe Indicator. Now, I want to talk about the Hoe Indicator because I feel like I got robbed. See, it used to be known as the stripper indicator. And if you watch the great movie The Big Short, there's a scene where Steve Carell's character goes to the strip club. He's chatting with the stripper, and he finds out that the stripper has a ton of loans and 6 mortgages and 5 houses and a condo. And he immediately realized that we have a bubble. If the strippers are going crazy and having 5 houses and a condo, then we have a massive bubble. And right after he says, short everything, call bullshit on everything. But it wasn't that guy who did the stripper indicator. I am the inventor of the stripper indicator. and I shared the story in details for the viewers in the previous video. But in a nutshell, you go back to 06, 07, Las Vegas, Nevada, which, by the way, back then, Vegas was hot, hot, hot. See, a lot of you come to Vegas these days expecting you're going to have fun. Oh my God, Vegas is so fun. This is crazy, Mav. No, it's not. This is the PG-13 version of Vegas. You got kids all over the place with these dumb parents bring their kids over here. Why? This is why I say, ladies, if you're going to come to Vegas, make sure you show extra cleavage. Just to stick it to these dumb parents bringing their kids over here. Take your kids to Disneyland, not Vegas. But anyways, back in 06, 07, business was hot and Vegas was, let's say, more fun than it is right now. And of course, the old-timer who grew up in the 70s would say, oh, but Vegas back in the 70s was better than the... Got it. Everything gets shittier by time. What are you going to do? But 06, 07, a lot of conferences in Vegas and parties over the weekend. And you have a lot of Wall Street guys coming over in the weekends during the conferences. You have these scumbags who are selling mortgages and scamming the public. They come out and spend their money in Vegas in the strip clubs. And I would say that was the peak strip club era. Because after that, strip clubs went down, and we'll talk about that in a minute, what happened after the pandemic. But you had all these hot chicks from all over the country, specifically from California, flying in the weekends to Vegas during the conferences that we had, and they go stripping for a weekend, making tens of thousands of dollars, which was a lot back then. You make 10 grand a weekend, that's a lot. And these strip clubs, of course, were filled by Wall Streeters. Guys who were trading, investing in the stock market, the hedge funds guys, the derivatives guys, all of them partying in Vegas. That was the top customer in the strip clubs. And that's how we know that we had a bubble. And the strippers would chat with all of these Wall Streeters, getting financial advice. Oh, you got to take a mortgage right now because it's cheap. You're never going to find a deal like this before. Take this, invest in that, buy that stock. That was the leading sign that we have a bubble going on. And I knew that this is going to be a really good leading indicator before the bubble declines and blows up. And since that point, it was coined the stripper indicator. Now you fast forward 2008, heading into the summer, I go again to the strip clubs, talking to the girls, and they say, hey, how come your friends are not coming here anymore? Matter of fact, nobody's coming here anymore. I might not fly here next week. And immediately in my mind comes this giant light bulb saying, whoops, this is probably the leading indicator that the stock market is going to crash and we're going to have a recession in the economy. And when you consider all of the excess and the insanity that was going on with the mortgages and all of the shitty products that were fraud to begin with, being dumped in pension portfolios and all of that, it didn't take a genius to say, you short everything here. Everything is going to blow up. And this is how the stripper indicator was born. And if we look at what the stripper indicator says today, here's a tweet for you. The real recession indicator is that I'm trying to get out of the strip club and get a civilian job. Even the strippers are now beginning to complain. No business in the clubs. Now I gotta get a job in McDonald's. Although, of course, after the pandemic, and honestly since the financial crisis of 2008, the strip club business began to decline. And the pandemic, of course, was the nail in the coffin. Never really recovered as it used to. But it gave birth to escorting. And this is why we now call it the Hoe Indicator. Because the strippers are not going to give you good information as they used to back in the day. But the hoes are gonna. You see, all of these trusted economists that you people look up to and listen to from CNBC and the Wall Street Journal and all of that, what kind of economic research they do, right? Harvard? The New York Economic Club? The Hamptons? Your boy, the Maverick of Wall Street, does real economic research. I talk to hoes, strippers, drug dealers, the Chinese mob, get the reality of what's going on in the economy. I mean, I only keep in touch with hoes to conduct my economic research. That's the only reason. And here's what you're going to watch out for. You go to Twitter, you see all of these hoe accounts. If they begin to complain about, oh, we're not having any more bookings like we used to. Business is slow. What the hell is going on here? That's your indicator to short the market and short everything with both hands. Feet might be involved too, because no other economic indicator would be as accurate as it is. I mean, think about it this way. Who do you think's spending all of this money on these hoes? If you said the Wall Streeters, you got it right. And then in D.C., got the politicians and the contractors and the lobbyists. Well, the Wall Streeters are getting fucked by the stock market, and the politicians and the contractors in D.C. are getting fucked by Doge. So it's just going to be a matter of time before you see the feedback and you see the complaints on Twitter, and that's your leading indicator to go guns blazing, shorting everything, calling bullshit on everything. I mean, you want to know how bad this economy is going right now? Even sugar daddies and now ghosting. I mean, imagine that. Your sugar daddy ghosts you because your sugar daddy's a moron. He chased Tesla and now he's down 50%. Now, just a tip for all the sugar babes out there. If your sugar daddy ghosts you, Just send him a text saying, FYI, I'm meeting with your wife tomorrow for lunch. He's gonna unghost you so fast. But honestly, if you're a smart hoe, you have multiple sugar daddies. At least two. You get one bullish sugar daddy, another one bearish sugar daddy. That way, you got exposure to both outcomes in the economy. You lose one, you got the other. And right now, bull sugar daddies are shitting their pants and ghosting. Bear sugar daddies, right here, baby. And just a tip for all of the sugar babes out there. If you're listening to the program, this is the most aggressive bear community on the internet. I mean, I got people who want to short anything every day, itching to short. And they've been rolling in cash lately. So might want to get a new bearish sugar daddy by posting in the comment section. And for the gents, don't fall for it because it's probably going to be Kim Jong-un disguised as a hot chick, and then he's going to take your information and clean up your accounts. But you know what else is a good leading indicator for the economy? It's this city right here, Las Vegas, where the Hoe Indicator was born. Before a recession or a crash, what we see is suddenly the gambling business in Vegas spikes, gets a massive boost. Everything else is going down, but the gambling business all of a sudden gets a boost, and then it crashes down. So let's go back in time here, December 27th, 2007. The headline from the New York Times reads, Las Vegas wins big. What are they talking about? Here it is. The sparkling gambling palaces that line the Las Vegas Strip are intended to disconnect visitors from the realities of ordinary life. But nowadays, Las Vegas is even managing to sever itself from the jittery economy, causing conniptions among retailers, restaurants, and other consumer-oriented businesses, including the rest of the casino industry. Gambling revenues in the Strip are up this year, way up in recent weeks, despite higher energy prices, a volatile stock market, a slumping housing market, and fears the economy may be heading into a recession. Some of the city's largest casinos are on pace for a record-setting year. In October alone, gambling revenues on the Las Vegas Strip were up 19.8% over the same month last year. What is the moral of the story here? You will get these fugazi economic indicators where you see the perma pumpers and the dogs in the media coming out and saying, oh, but hey, gambling in Vegas is pretty good. People are gambling on football or basketball right now, college ball. How could you say that the economy is bad? It's the same thing that happened back in 2007. They went crazy in Vegas, and fast forward not even a year later, everything crashed down. And if you've been following the stripper indicator, it told you what's going to happen ahead of time. You fast forward to August 11, 2008. The headline reads, Las Vegas Strip, Atlantic City Casino gambling revenues drop. Gee, why did they drop? Because the stock market since the fourth quarter of 2007 to the summer of 2008 went down by more than 20%. A lot of folks say the stock market is different than the economy and all of that bullshit, but at the end of the day, this is a rigged economy. This is a Ponzi scheme, and it's all held up by the stock market. You live and die by the stock market. We should be in a deep recession right now, as we speak, absent of the stock market mania bubble that we call AI. Absent of that, we would be already in a recession. And the moment the market goes down by 20%, you'll see layoffs all over the place. Well, gee, what happened? Yeah, the market went down, and that impacts the economy. Casino gambling revenues on the Las Vegas Strip and in Atlantic City fell after cash-strapped U.S. consumers curbed spending on entertainment and travel. Sounds familiar, as we have right now? And listen to this, gambling revenue in the Strip dropped by 3% to $486.4 million in June, resulting in the first fiscal year decline in 6 years. That was another leading indicator. Vegas will let you know right away what's going to happen. And of course, you got Atlantic City. I mean, if you have syphilis in your bucket list, that's where you want to go, Atlantic City. But in the present day, folks, here's the headline, 6 straight monthly declines on the Las Vegas Strip, but they're not worrying the analysts. Everything is fine, they say. And here's another headline for you. Las Vegas Strip gaming revenue down, industry growth declining, group says. But that's not a good leading indicator for the economy. And I can let you know here from my own view, what I see, it's an interesting phenomenon, really. It is a reflection of what's going on in the economy, the actual economy, which is, again, a rigged economy, and the discrepancy between the classes is absolutely insane. It's like the Gilded Age. You got the top 10% of earners doing more than 50% of spending in the economy, and the rest are just slaves working paycheck to paycheck. And the moment they lose their job, they go delinquent on their credit card, then their cars get repossessed and their homes get foreclosed. And God forbid you get a medical emergency. Might as well shoot yourself in the head and take the merciful way. That's the reality of the economy. What you see here in Vegas is an interesting phenomenon. So you have the higher end resorts and restaurants, the 5-star restaurants that cater to the affluent consumers. Those are hot. If you go to the Wynn, for example, or any 5-star restaurant, you see business as hot as you can, and you wonder, what recession? What are we talking about here? And then you go to these shitty casinos, the absolutely filthy ones, where the rooms are like $27 and you can bet $1 on a blackjack table, those kind of casinos. Those are still hot. Those are still getting business and packed and all of that. But anything between, anything that, let's say, caters to the middle class or the regular consumer, there's not the affluent or the, let's say, to be nice, not the so affluent, those are dead. Those are ghost towns. It's a really interesting phenomenon to witness. And the leading indicator we have to observe all the time, and it ties in with the Hoe Indicator and all of that, is when the affluent consumer begins to pull back. It's not because they're starving. It's because they lost confidence in the economy. They lost confidence in the market. And once they begin to pull back, that's the last leg that has been holding the economy. It goes kaput and the whole thing comes down. Now, since we highlighted the importance of the market to the outlook of the economy, let's talk about the market a little bit. Because you have your boy Tom Lee, perma-pumper, right? And he comes out and says the market will ultimately rebound from the tariff scare, as it did in 2018. I'll give you a second here to figure out what the difference was between 2018 and today. That's number one. Number two, who's making all of the money from the stock market declines or corrections so far? If you said JP Morgan, the laundromat, you got it right. JP Morgan stock traders made a killing as the market went down. By the way, former employer of Tom Lee got sacked because he made the worst call in stock market history when he said buy Citibank before the crash, and then the stock went down by more than 96%. But now he found a new generation of donkeys that he can scam. To each his own, really, but we are not without a source of hope. And throughout the week, by the way, it looked kind of tough. The market was attempting for a rebound. It couldn't happen. It couldn't stick. But I was persistent. In my Discord to my members, I was saying, you know what? The risk right now still favors the rebound. So you got to give it the benefit of the doubt. And comes Friday, I was proven right because we got a piece of news that will become an important catalyst to what happens this upcoming week, one step at a time. See, Donald Trump in the White House declared April 2nd as Liberation Day, because he's going to do the reciprocal tariffs. And he went on in the State of the Union. He said, I went with April 2nd, not 1st, because I want to be serious about it. And don't want to get people the impression that I'm just doing Fool's Day. The problem is, absent of negotiation or settlement before the deadline, what's going to happen is we're going to see one of the biggest market declines recently if this tariff deadline goes through as we expect. No negotiations, no delays, no extensions, no nothing. And the White House knows that. Comes the headline, the market is going to crash. So they're now scrambling to find a fix because they stuck their foot in their mouth. And yes, we got Scott Bessent coming out saying, we don't care about the stock market anymore. It's okay if it goes down. No, it's not okay. You know it's not okay. You're freaking out about it, but you're trying to hide it. And it's not working out. But the White House is in a tough position because they're talking tough, but they cannot walk the walk. Every time the market goes down, they have to address the market. And we see, oh, we got an extension for whatever. Oh, Mexico called. Oh, China called. China called. That's what we got Friday. China called. And China's like, dude, well, we don't know what the hell he's talking about. Nobody called nobody. But it doesn't matter. They're going to try to pump it. They're going to try to work out something behind the scenes because they know that this is going to be a disaster. The question is then, why did you hype it? Why did you go with the deadline without a plan? If nothing happens this week and the market assumes that we're going to go through with the reciprocal tariffs, we're going to see a massive decline here, folks. What is he going to do? Backtrack? Give another extension? Well, that's going to look weak. At some point, everybody's going to figure out. And maybe we don't have negotiation right now because the Canadians know, the Mexicans know, the Japanese know, the Chinese know, the European know. Everybody knows that he's going to threaten and talk tough and all of that. But the moment the stock market goes down, he's going to freak out and backpedal and give other extensions and stick his foot in his mouth. But right now, it's so obvious that if he backtracks, it's going to be a massive weakness, a massive weak position. And this is why I said that the White House maybe pinned themselves in a corner here, where they have to go with what they threaten and go with the reciprocal tariffs. And whatever happens to the market happens to the market. And whatever spills over to the actual economy, so be it. But like I said, it's not without a hope. They're going to try to do a cute move here before the deadline. And the key word is try. Because on Friday's session, he came out and said there will be flexibility on the reciprocal tariffs. Of what does flexibility means? Nobody knows. Because he says we're not going to reduce the rate. The rates are still going to be reciprocal. If India tariffs 100%, would tariff Indian products 100% too. So where's the flexibility here? It doesn't matter. They just wanted to pump the market and rescue it from collapsing Friday. Because they did not want to go to the Sunday shows and Bessent comes out again and tries to bullshit his way out of the declines in the stock market. They didn't want to do that. So they had to close on a positive note by whatever pump they can. But again, there's a glimpse of hope. And this is why you cannot dismiss the rebound altogether right now, because we got a headline like this from the BBC. UK mulls big tech tax changes to avoid US tariffs. So they're trying to play some soft diplomacy here. Hey, can we work out a deal? Is this just going to be a reciprocal for now, but then we can work out deals? The market is going to try to look to the half full side of the glass. But if nothing happens, let's say by Friday this upcoming week, and we head into the weekend, and the assumption is when we have the tariffs comes April 2nd, then you're going to see that freak out. But the market will give it the benefit of the doubt before that. And this is why I say don't dismiss the rebound entirely, at least not right now. Of course, do we have concerns about the market in the longer term? For example, when you look at the valuations, absolute insanity. The price to sales ratio is back at the highs again. This is excessive, and when things become uncertain and a little chaotic, investors would look at the valuations, and now the valuations matter. Under uncertainty, I don't want to commit the capital. Even an asset manager doesn't want to commit the capital for his clients at these kind of valuations when you have all of the uncertainty. And that's a significant change because we hammered a huge portion of the dip buying in the market. And this is why the rebound was mediocre this week. It needs a catalyst. It needs something that forces the shorts to cover. It needs something that causes a stampede and call options again. It needs to cause the algorithms to begin to buy. Well, how would you do that? You got to back off the tariffs entirely, which I don't think is going to happen. When we talk about the longer dated concerns for the market, listen to this headline right here. Private equity firms are getting rid of their equity, meaning that the insiders are dumping. On the other hand, check out this headline. U.S. households are sitting on a record amount of stock. That could be bad news for the market. So you have the smart money exiting, the dumb money staying and continuing to buy the dip. U.S. households have the highest allocation to stocks since 1951. The institutions, gambling with the seniors and the pension retirement money, they have a near record long allocation to stocks, only eclipsed by the peak in 2000. Gee, I wonder what happened back then. Not to mention, of course, that foreign investors are beginning to dump U.S. stocks. They have the highest allocation to U.S. stocks since 1968, and they're beginning to liquidate. They're beginning to exit. What if the institutions do the same? Then the last block will be the retail investors, the households, getting out. See, in the longer term, when you look at a chart or what's going on in the market right now, in the longer term, you see the possibility for more sellers showing up. In the shorter term, though, with the market being oversold as it is, you see the possibility of more buyers showing up. Net buyers, the shorts covering the algos, the option traders. You just need to have the trigger. You need to have the catalyst for that to happen. But in the long term, we have more sellers than buyers. And these sellers are holders of the most popular stocks in the market, the mega cap technology stocks, among them NVIDIA, of course. So if NVIDIA begins to break, that's going to initiate a wave of sellers, a massive wave. And so far this week, the chart doesn't look pretty good. You got the CEO, Jensen Huang, from conference to conference, pumping and hyping. Last year, that stuff would have pumped NVIDIA stock by at least 5%. Now it drops it down because folks are looking at the glass half empty, not half full as they used to. Change in psychology. And now we have some analysts who are now saying that NVIDIA might not grow at all next year. If that is the case, then the stock is going to go down. It could be aggressive because we have over-concentration in that stock. Another problem for the market to keep in mind. Now, folks, we discussed in last weekend's video some rebound/dip buying ideas. Some of them worked out pretty good this week, like JP Morgan and Goldman Sachs. Some have yet to work out. And then we made a video also for the members of this channel discussing the falling knives, how to trade them and deal with them. And some of those ideas are working out too. And again, if we see things changing this week and we shift back to bearishness and we dismiss the rebound altogether, I will give you guys ideas to bet in the downside. And if it becomes clear that the rebound gaining momentum, we'll give you also ideas to how to expand in your rebound plays. So folks, consider joining us as a Maverick member. You will find the links in the description. You can do it here on YouTube or on Patreon, whatever your preference is. Join us to access the daily show and not miss out on the conversation, the coverage that we've been doing every day. But folks, the show is not over yet. Let's segue and do some charts and some ideas. Let's see what the charts say and if there are any ideas, bearish, bullish, that we can play, and then wrap up the show. I'm going to begin the technical analysis segment by once again my conditions for or confirmation layers for the end of the corrective wave, aka the confirmation layers for a rebound. You see the majority of these conditions are being met. The risk of a rebound is higher than the risk of market declines. And again, to recap, the conditions are the VIX below 23. Number 2, crude oil trading above 68. Number 3, the US 10-year is trading above 4.3%. Number 4, the IWM, the small caps, outperforming other indices. Number 5, the Dixie, the dollar index, is rebounding along with bond yields. Number 6, Bitcoin trading above the 200 days moving average. Number 7, risk-on stocks outperforming risk-off. Let's check out some of these charts, beginning with the VIX. This is the 2 hours chart, the one that I like to look at. And last week, we said that the risk is for the VIX to go down and visit 20. Indeed, we've done that, and we closed below 20. So we're not above 23. And therefore, this indicator right here favors the rebound for now. It looks like it's not oversold. It could go lower. We could see the momentum in the MACD turning bearish, and we could head down to 1760, for example. That would be positive for the market. What about crude oil? It is trading above 68. You look at the MACD indicator, it is splitting and showing bullish momentum, so that's also a confirmation for risk on, aka the rebound. Looking at the 10-year yield daily chart, it dipped below 4.3% because of the FOMC, but since then it's been fighting its way back. It's trading above the 200 days moving average in orange. So sure, it is below 4.3, so we don't have satisfaction in that condition. But it is finding a good support and moving higher. Of course, we have a bunch of macro data coming out this week from the GDP, the PCE. All of these will be impactful to the bond yields. Then we'll look at the IWM daily chart. It's not leading. It wasn't leading on Friday's session at all. It was the laggard. But again, it still has a positive pattern for now of an inverse in his shoulder. You see positive divergences in the MACD and the RSI indicators, so you got to give the IWM the benefit of the doubt. If it takes the lows in this inverse in his shoulder pattern, then okay. Let's initiate some shorts on the IWM aggressively and such. But right now, give it the benefit of the doubt that it could rebound and play this inverse in his shoulder. How about the dollar index? Beginning to find some footing, finding some support, positive divergences in both the MACD and the RSI indicators. Beginning to find some footing here, so the dollar moving higher along with bond yields on Friday's session, so we got satisfaction in this condition right here. And by the way, if the dollar continues to rebound, that's going to be bad for what? Bad for gold, the defensive, which will be a permission for risk on in the mega caps and the rest of the market, the stocks. It will be also bad for European equities, like the German DAX and Chinese equities, the foreign markets that have been performing while the dollar have been heading down. So keep that in mind. Now, what about Bitcoin and the 200 days moving average? At least at the time of the recording of this video, we're not there yet. We're not above the 200. We're just flirting with the 200 days moving average, so there is no satisfaction of this condition right here. So to recap again, we got the VIX below 23, we got crude oil above 68, we got the Dixie rebounding along with bond yields, but we don't have the 10-year yield above 4.3, we don't have the IWM outperforming the market, we don't have Bitcoin above the 200 days moving average, we don't have risk on stocks outperforming risk off. So it's a weaker case than last week for the rebound. But right now, it's not decisive yet one way or the other. It's leaning toward, hey, the rebound stalled here. But for all you know, you might wake up Monday, you see the 10-year trading above 4.3. You see the algorithms buying the IWM. You see Bitcoin all of a sudden catching a bid above the 200 days moving average. So we'll keep an open mind for now. But certainly the rebound weakened. It needs a catalyst to gather some steam again. Now, if we look at some of the charts that could be relevant for you here overnight, we'll begin with the E-mini futures daily chart for the S&P 500. What do we see here? If you look at the momentum indicators, we see positive divergences in both the MACD and the RSI, so you're still going to give the benefit of the doubt for the market to try to rebound. And it could be, by the way, in a bull flag formation right now. I gave you a line in the sand on Friday's morning brief for those of you who follow my Discord. And I said if we have the E-mini futures closing below 5,673, to me, that's going to be the point where I'm going to close my rebound plays and initiate short plays in the index again. Obviously, we don't have that yet. We closed above. Looking at the NASDAQ futures, weaker than the E-mini S&P futures, forming a bear flag pattern all in all, but it is butting its head against 20,000 over and over again. We see the momentum indicators, the MACD and the RSI turning positive, so we're going to give it the benefit of the doubt that it could trade above 20,000 this week. If it does, then there is hope. It could even retag 21,000. If it doesn't, or let's say it crosses above 20,000 for a moment, then comes back down again, closing below the number, then the odds for another flush will increase. Some of the important mega cap names like Apple, what do we see in this name right here? It flushed down big recently, got way outside of the lower Bollinger Bands, so it caught some stability. And Friday's candle could be considered as a bullish engulfing candle on a higher low. But this pattern is within a larger bear flag pattern. So that's the dominant pattern. It's a bear flag for now until proven otherwise. What does otherwise mean? closing above 220. If Apple doesn't close above 220, then it's not out of the woods yet. You look at NVIDIA, it is finding some stability at around 116.5 for support, and then we got resistance at the 20 days moving average, the white line within the Bollinger Bands. But NVIDIA is not out of the woods yet. It needs to trade above 120 and close above 20. I would say even over 129 before we say we're out of the woods. Because right now it could be a formation of a topping head and shoulder, and down she goes again. Now let's do some bonus charts. We begin with the bearish ones. And again, bear in mind, if there is an event where we, for example, say, okay, the tariffs will be delayed, or we found a deal or whatever, then everything's going to rebound higher together. So keep that in mind. Likewise, if we have a market flush because there is no deal and we're going to go through with the reciprocal tariffs comes April 2nd, then you'll see an inclusive flush in the market. And then even the bullish charts that I'm going to give you in a minute might not play out. So I'm just giving you the technical setup here. You got to do your homework and look at the dynamics of the market at the given day that you want to trade at, Monday, Tuesday, whatever, and consider the development in the chart. But right now, if I'm looking at the chart of DIS Disney, it looks to me as a giant bear flag pattern, and if we have the close below 97.60, it'll be a confirmation that the bear flag is playing out. And over the weekend, we did not get good news from Disney, as Snow White bombs. Then you got the ticker V, Visa. Again, it looks as it's going to retag the trend line here, daily trend line, and it's playing already a bear flag pattern. So if there is downside in the market this week, it could be led by names like Visa. You have SBUX, Starbucks, got the rising wedge, and then the break below. Really nasty flush here, bear flag already playing out. The RSI is shifting its momentum negative again, so it could be gunning for a retest of the 200 days moving average. We could see more declines here in Starbucks. Then you have Coke, KO. And if you look at the daily chart here, we have a gap and we're trading above the 200 days moving average. This is part of the staples, the stagflation theme, so it's doing okay. But you notice this pattern across the majority of these stagflation stocks, the topping head and shoulder, which is again supportive of this idea that the market is ready to do a risk-on rotation, but it needs to get that tariff deadline out of the way. Otherwise, it's not going to be able to pull it off. Let's do some of the bullish charts, quote unquote, beginning with ARM, daily chart. Below the trend, yes, hammered, beaten, bruised, but do we have a pattern of what it looks as a cup and handle pattern? We see momentum turning positive in the MACD and the RSI. Could it be? If we have a good week, a good rebound week for the market, it could be led by names like ARM. You look at DKNG, DraftKings. A lot of you have been saying, hey, Mav, what about the NCAA and the gambling revenue and all of that? Maybe you're onto something. The larger theme right now is a bear flag pattern in DraftKings on the daily chart, but it's been finding stability at the same support over and over and over again. Furthermore, the momentum indicators, as I'm highlighting in the MACD or the RSI, are both heading toward positive divergences. Furthermore, the stock managed to close the day on Friday above 39. So it could be an idea where we could see DraftKings, for example, gunning at 42.5. And it could make a good trade here for a rebound. Likewise, you have ETSY, and this is more of a folding knife kind of scenario, so I would refer you back to the folding knives video. And here we're going to identify a stop loss. This is going to be the support 43.43. The moment it trades below, you got to sell the stock right away or close your options. But right now, could it be maybe finding some stability and you see the momentum indicators shifting toward positive? How about HIMS? Same thing, you look at the MACD indicator, been negative since the top, and it's been flushing down big, but now we've exhausted the bearish momentum, and we're about to shift to bullish momentum. You see the little positive divergence in the RSI in the daily chart. You see the falling wedge pattern, which the chart is breaking above, so we could see in a risk-on rotation, and good news from the trade war, we could see HIMS catching a bid here in a big way as the shorts begin to cover. How about NTR, Nutrin, flirting with 52.50, forming a bull flag pattern. So we'll give it the benefit of the doubt here. You see positive momentum in the RSI, the MACD, and the Vortex indicator. So it could be just gathering some momentum here before it breaks above 52.5 and create a release of energy. Then we got PLTR, Palantir. It looks as an inverse head and shoulder pattern in Palantir, closed above the 50 days moving average in blue. Momentum in the MACD is turning positive. We see positive divergence in the RSI, so we'll give it the benefit of the doubt here that it could close the gap in or around 100. And this is why the trade that we've done on it beforehand was the 90-100 call debit spread. Then you got Uber. It looks like a giant cup and handle pattern already kind of playing out. You see the momentum in the MACD shifting to positive. The RSI has positive divergence, so we might see Uber gunning to 80 again. How about WIN? WINN. We just talked about the affluent consumer and all of that. Friday offered a really interesting candle. It got oversold outside of the lower Bollinger Bands, retested support at about 80.5, and then came back rebounding with a nice wick. Could it be with a higher volume, by the way? So could it be a bottoming candle for WIN? I'm just floating some ideas here, folks, for you. You got to write them down and do your own homework and come trading on Monday. Assess where the risk is. Is it to the upside, as in good news from the trade front? Then you want to conduct some trades in some of the ideas that I just shared with you right here. If no, and the market begins to lose momentum, then you might want to pick on some of the bearish charts that we covered, and we'll give you many more as the week progresses. But folks, let's segue to the conclusion of this video. What do we have on the economic calendar this week? Comes Monday, the 24th, we have the flash PMIs, services and manufacturing. Those are going to be really important because they're a pulse on stagflation. If the headline readings come out weak, but the price indicators come out hot, that's going to be problematic and it's probably going to freak out the market. Now, Tuesday, the 25th, we have the S&P Case Chiller Home Price Index. This is a little lagging, but always important. Then we have consumer confidence and new home sales. Wednesday, the 26th, we have durable goods and a speech by the St. Louis Fed President Mausoleum. Thursday, the 27th, it gets a little more interesting because we have initial jobless claims and the GDP. This is going to be really important and watched GDP. We got advanced retail inventories and trade balance, along with wholesale inventories, and then we got pending home sales. In a speech by Fed Zombie Barkin from Richmond. Comes Friday, another important macro day, the 28th, we have the PCE. And a reminder, once again, there is a suggestion that the PCE should be heading higher, and that could be problematic. Now, consumer sentiment, the final reading, this is going to be really important. Do we see a change from the preliminary reading, where folks are cooling off the recession fears a little bit, getting a little more optimistic? That could be a catalyst. But at the end of the day, folks, the macro is important, but nothing outweighs Liberation Day. If no deals happen and the tariffs go through, my expectation is we're going to see a big flush in the market. If there is a deal or negotiation or delay, that's going to be the catalyst that the market needs for a rebound. If you thought that was complicated, or how the hell do I trade this, Mav? Welcome to the Trump market. We've dealt with this back in 2018. It was volatile. And sometimes when we have lack of clarity in distribution patterns, as we are right now, distribution means consolidation after a big pop or a big drop. Maybe you don't want to trade the distribution pattern, because if you get the timing wrong or the direction wrong, you're going to pay for it. A lot of traders might be better off waiting for a break out of the distribution pattern, either as a confirmation for a rebound or a confirmation for another round of flushing down. I'll give you all of the numbers that you need to look at for these confirmations in the morning brief tomorrow in Discord. So once again, folks, I encourage all of you to join us as a Maverick member, either here on YouTube or on Patreon, following the links in the description. But let's wrap it up right here, folks. This is all I got for you for now. Hope you enjoyed the show, and if you did, return the favor by pressing the like button, subscribing to the channel, and considering becoming a Maverick member. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
200% on all my loans?
What do you mean all your loans? We're talking about 2 loans on 1 house, right?
I have 5 houses and a condo.